For someone who spent 30,000 hours digging into academic papers and the Fed and all this stuff, if there's a black swan event that just collapses trust, you could see a little bit more of a dramatic move into Bitcoin. We've seen clearly kind of a short squeeze, positioning got stretched. The dollar is even more overvalued than it was in 1985. Balancing the budget would result in a GDP contraction worse than COVID and worse than 2008. So severe that it would throw us into a debt spiral immediately. As the trade deficit has gotten larger and larger, the net worth of the top 1% is increasing at a faster rate than GDP. Well, if we start issuing interest-bearing debt to buy Bitcoin, China can just turn around and say, look, well, we're only taking Bitcoin. There's nothing we can do. So the Bitcoin ends up flowing out. M2 money velocity, S&P in gold terms, all of these peaked around the same time. I don't see how any of those things are bullish for the dollar. The income needed to qualify for a mortgage on the same house increases by 200% in 5 years. You're going to tell me that inflation's only 21, 22%? The S&P 500 has increased 10 times faster than the average hourly wage. So the current account deficit on a quarterly basis is about $450 billion. It's about $150 billion per month that mechanically must flow into the dollar. I just don't see how we don't have higher inflation for the next decade. Scarcity is the antidote, and Bitcoin, we know, has one of the lowest supply increases of any asset.
Robert, thank you for joining me, sir.
Yeah, good to be here.
We got introduced by a mutual friend, Roberto, formerly known as and still known as popularly as Peruvian Bull. He reached out, introed us via email, said had to talk to you. We've been going back and forth a little bit through email this week, and just really excited to touch on some of the topics that you're focused on and passionate about: globalization, silent depression, Triffin's dilemma. And as we were discussing right before we hit record, let's start with globalization, because obviously I think this year particularly we're seeing political reactions to globalization in the form of tariffs and economic policy here in the United States making big shifts. And so let's start with globalization. How did it get to this point, and where do you see it going in the future?
Yeah, so really started in the 80s, at least kind of from what I can gather from balance of trade, current account data. Started in the 80s, and basically, what we did was we offshored over 5 million high-paying manufacturing jobs in critical industries to the rest of the world. And the reason that this was done was the labor in the developing emerging market economies is much lower. And so if you're a multinational corporation, you're able to, increase your profit margin significantly by utilizing that cheaper labor, despite, being an American company and eventually selling your goods in America and benefiting from the American people. So, it started in the 80s, and, it also kind of coincided with some of the silent depression stuff. There were clearly some immigration policy, even under Reagan, under both political parties, that kind of started to exacerbate some of the wealth dynamics that we started to see. But, the other side to a trade deficit that many people don't talk about, they're talking about it more recently, which I appreciate, is this capital account. So if you are running a current account deficit, as the US has, there is a opposite side to that, which is a capital account. And so we've been running a current account surplus, meaning we are importing, the value of goods that we are importing is higher than the amount of goods, the value of goods that we're providing to the rest of the world. And the way that you balance that current account is by an inflow of capital. And so this, kind of goes into the Dutch disease dynamics with the dollar, where, certain industries have done very, very well from this. You think FIRE, right, is the little acronym that gets thrown around: finance, insurance, real estate. If you are a MIT grad, in engineering, you're not going to build rockets for NASA. You're going to build a algorithm for Jane Street, right? So certain industries have done very well with these billions and billions, hundreds of billions, cumulative. It has worked out to be trillions of dollars, tens of trillions of dollars actually, in capital inflows. And this can be real estate. This can be, equities, corporate equities. equities, the U.S. stock market. This can also be treasury bonds, of course. And certain industries have done exceedingly well. And I would also point out those that are wealthy enough to afford to own financial assets, have also done well, as not only the corporate profit margin has been boosted due to that cheaper labor, boosting the profit margin for the corporation, but also due to the structural dollar bid. And this is part of the reason the dollar has become kind of so grossly overvalued. And as the dollar continues to appreciate, our goods are become less and less competitive in the rest of the world. So there's a lot of kind of concepts interlinked there, but I think it ties in well to some of the tariff dynamics that we're seeing now, a rise of what I would call, I wouldn't call it protectionism so much as I would call it economic nationalism. For the longest time, for some reason, our policymakers worried more about building the middle class of Indonesia and Malaysia and China and India than they worried about building the middle class here. And of course, traditionally, manufacturing jobs, were kind of the cornerstone of the kind of post World War II American dream, right? The family, especially in the Rust Belt, we've seen that area have been absolutely decimated. And this has led to not only the economic and financial consequences with, this kind of huge amount, tens of trillions of dollars coming into capital markets, boosting the value of, say, stocks and keeping bond yields low, boosting the dollar, of course, and real estate. Not only that, but you also have this dynamic where, socially in America, we see the highest suicide rate going all the way back to the Great Depression. We see deaths of despair that are double the rate that they were during the Great Depression. So deaths of despair being defined as suicides plus drug overdose. We know that, the prior industrial heart of America in the Rust Belt, it was especially hit during the opioid crisis. And I think a lot of these concepts are kind of interlinked, and it goes into the issues with the dollar. Dutch disease, I think, refers much more to the benefit for certain industries, right? The Netherlands discovered this great natural gas field that was going to revolutionize, boost their economic output. Well, it ended up hollowing out, all their other industries that had been core to their kind of economic success leading up to that. So, we've seen this hyper financialization of the economy. That's what's really driving kind of the wealth inequality story, is those who own financial assets and those who don't. And the current account deficit, the trade deficit, is really great if you're one of the, top 1% that own the vast majority of U.S. equities. The top 10% own 93% of household equity exposure. So we know the bottom 50% have debt. That debt has skyrocketed in cost due to the interest rate hiking cycle. And meanwhile, the top, 1 to 10%, they own financial assets, and financial assets have skyrocketed due in part to this current account deficit. I would say that, the current account deficit on a quarterly basis is about $450 billion. And so if you take that down to per month, it's about $150 billion per month that mechanically must flow into the dollar and then financial assets within America. That's $150 billion a month is a significant amount of money. Per quarter, that would build, I forget the exact number. I did the math. It was like 8 or 9 Ford class aircraft carriers, right? So it's a huge amount of money that we are, needing to finance via other ways. And that gets into the Triffin dilemma with the need to run this current account deficit due to being the reserve currency issuer of the world. And so I think, I'm not supportive of every single thing that Trump has done, but the one thing that I have been very outspoken in favor of is the tariffs and the at least the attempt to start to address some of these issues. I mean, it ends up being a national security threat when, our industrial capacity is so hollowed out that we rely on what a lot of people would consider to be an enemy for 65% of active pharmaceutical ingredients, Or, we see on the defense side, we're losing a proxy war to a country with 1/12 of our GDP. And then you look at the net international investment position, which has accrued over many, many years of this kind of prolonged current account deficit. That NIP refers to how much assets do we own of the rest of the world versus how much of our assets do they own. And that's negative 100% of GDP. So it's a level I've looked for another kind of parallel to that, and I've never seen a parallel to that in history. Which means all of our, whether it's U.S. Treasury debt, even corporate equities, to some degree real estate as well, we saw in April what happens when foreigners start to dump U.S. dollar assets en masse. And it basically brought, the president of the United States into capitulation on one of his core, policy agenda proposals. So the power that net international investment position being so insanely large in a negative direction, that power is immense. Foreigners literally own us to some degree. And we start to threaten tariffs. We put on tariffs and they don't like that. They can just start dumping treasuries and force Trump to capitulate. So there's a number. I mean, we didn't get here overnight, and a lot of these issues are interlinked. They're complex and they'll be difficult to fully unravel. But I do see positive steps in some of those areas.
Yeah, this reminds me of a conversation I had with Lynn Alden a couple of months ago after, I believe, her May or June newsletter, which covered this sort of like the effects of Triffin's dilemma. You hollow out your manufacturing base, flood these emerging markets with dollars so that they can build the things that you're replacing, and then that flows back into financial assets. And I think what we sort of dug into is that works for a period of time, but eventually it falls under its own weight because you just have this imbalance socially, economically, that exists domestically that is untenable.
Yeah, well, I would argue that looking at some of the societal KPIs, I'm a big pretty outspoken on what I call GDP maximalism, right? This idea that GDP is the end all be all for measuring the success of an economy. I much prefer to look at real wages, for example, or the suicide rate, or drug overdose deaths and deaths of despair, kind of broadly speaking. I think antidepressant prescriptions, which have 13x'd in the past 50 years, some of those metrics are pointing to a very sick society. And I think we see that with the political polarization that, to some degree, Trump is a symptom of. And I think it'll continue to get worse. I mean, we see kind of, I said it before Mamdani, but I warned people. I said, Trump is your kind of populism, right? The kind of populism a lot of people might like, but be careful because, the natural consequence of kind of all of these things is that we see the other side of left-wing populism. And sure enough, Mamdani kind of came out of nowhere and did really well there. So yeah, politically, I think most of the issues we see in America are downstream from economics. And that is not just because I'm a macroeconomic nerd, but because that's genuinely how the correlations that I found, that's generally what the data supports, at least for me. And at some point, like you said, it has to come to an end. Certain systems are not sustainable. And I would argue that a 7% pro-cyclical deficit in combination with a 4.5% current account deficit is not sustainable in any reasonable world. And the unfortunate thing, for us as Bitcoiners is, Lynn is great, talks about broken money and fractional reserve and debt-based money and a lot of those concepts, which I think are great. I've been talking about this concept of kind of global broken money, which is that in trade, going back hundreds of years, there have always been imbalances. There have always been countries that, run a trade surplus versus another country. The release valve used to be, when it was gold-backed money, the release valve used to be that the currency would move, right, to offset the currencies were valued on balance of payments, for example, the currency would move to offset that particular imbalance over time. It's not an immediate overnight sort of thing, but over time, the currency would be this kind of equalizing equilibrium force. Well, that's completely broken down with the dollar's reserve status. The dollar, at least as of a couple months ago, is even more overvalued on a purchasing power parity basis than it was in 1985, leading into the Plaza Accord, when we saw this historic, weakening of the dollar. So the dollar has kind of remained way too strong for way too long, and has just kind of exacerbated these issues. And if we had a neutral measuring stick against which to measure fairly on fundamental basis, the actual strength of currencies, we wouldn't see anywhere close to the degree of problems that we see. So that's one of the really unfortunate things. And, sure enough, we have central banks kind of gold is over the past couple of years, gold has been kind of, on the rise. My hope is that Bitcoin is kind of joining that in terms of use as a reserve asset. The problem for America with something like, a Bitcoin strategic reserve, however, is that because we run a twin deficit country, the only thing we can accumulate is debt. When you think of it in those terms, it's, I think most people would agree that's not sustainable. If we start issuing interest-bearing debt to buy Bitcoin, for example, then, at some point, China can just turn around and say, look, all those the 65% of active pharmaceutical ingredients that you rely on us for to keep your people alive, well, we're only taking Bitcoin, right? And because we're a twin deficit nation, there's nothing we can do. So the Bitcoin ends up flowing out. A twin deficit nation, by definition, is kind of net unproductive. So really, we got to address kind of the deeper issue, in my opinion, which is why are we running this twin deficit, and what are some policies that can be done to address that actual underlying kind of root problem, if that makes sense.
Sup, freaks? This rip of TFTC was brought to you by our good friends at Bitkey. Bitkey makes Bitcoin easy to use and hard to lose. It is a hardware wallet that natively embeds into a 2 or 3 multi-sig. You have one key on the hardware wallet, one key on your mobile device, and Block stores a key in the cloud for you. This is an incredible hardware device for your friends and family, or maybe yourself, who have Bitcoin on exchanges and have for a long time, but haven't taken the step to self-custody because they're worried about the complications of setting up a private public key pair, securing that seed phrase, setting up a PIN, setting up a passphrase. Again, Bitkey makes it easy to use, hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a Bitkey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20.
Sup, freaks? Guess what? We launched a browser extension. It's called Opportunity Cost, and it helps you see the true cost of everything in Bitcoin, convert prices to Bitcoin as you browse the web. Opportunity Cost automatically displays fiat prices in Bitcoin or sats, helping you think in a Bitcoin standard. It works on Amazon, Zillow, X, your bank account, QuickBooks. You can convert everything to Bitcoin. It's really cool. It's also 100% open source, MIT license. We don't collect any data. All of the conversions happen in your browser on your local device. It's a great way to recalibrate your life and begin thinking in sats. Go check it out at opportunitycost.app. That's opportunitycost.app.
And like going back to what you said earlier about Trump's capitulation in April due to the dumping of treasuries, it seems since then, I mean, there's still some posturing, hard lines, policies, decisions being made in regards to tariffs, but it seems pretty clear combination of Trump and Dissent specifically have sort of committed to this. We're going to grow out of the debt situation and really turn it on turbo, as Elon said a few months ago. And I guess that's the big question, like that capitulation, that recognition that the only way out is through is a bit unnerving.
Yeah, I mean, I think it was November when Elon started talking, we're going to balance the budget. We're going to cut $2 trillion from the deficit. I did some math, and granted, I don't have a PhD in economics. I'm no mathematician, right? But just this humble nerd's math found that balancing the budget would result in a GDP contraction worse than COVID and worse than 2008. So, I always kind of faded the Doge thing because it just, number one, most of the spending, as you know, is entitlements, and you politically can't really touch that. But then number two, like if you were to really cut that much government spending, it would result in a contraction of GDP so severe that it would throw us into a debt spiral immediately. So I always kind of was skeptical of Doge. I support it, right? Like on a personal level, I very much support cutting all that waste and fraud and abuse. But from a just pure objective accounting standpoint, one man's fraud is another man's income, right? That USAID worker who's getting fraudulent, wasteful money, right? They have a mortgage, they have a car loan, right? They have personal loans and credit cards, right? So they buy groceries, they buy insurance. So yeah, I was always skeptical. I was hopeful, right? Cautiously optimistic that they would cut something, but we look back and they cut like 1.6%, I think, of the federal budget. So yeah, so I noticed that too, that pivot that you noted a couple months ago. I noticed that too. It was like all in 1 week. You had Bessent, Elon, Chamath, all the key people coming out and basically publicly abandoning Doge, right? Just like, yeah, we're not going to cut our way out of this. The key, how we're going to win is to grow our way out. And I thought to myself, okay, so here's the negative real rate story, right? Like they're going to come in, they're going to propose, they're going to find some way, whether it's explicit QE, yield curve control, tinkering with regulatory levers like SLR and LCR, but they're going to find a way to get negative real rates. And that's kind of the direction I think things are headed in, generally speaking, for the next 12 months or so. It appears that they really want that negative real rate environment, especially in bills. And bills, should be pointed out, that transition happened under the last administration with Yellen, and Bessent was very critical. And, as I just did a video on the QRA, the most recent one, he is not changing the issuance schedule, right? So I think he recognizes, the reality of the situation of the bond market, especially at the long end. But, we're talking about a shift even more into bills. And what's important for people to understand is, and you can find this on TradingView, right? Pull up a single percentage chart, right? And throw on like a short-term bond ETF, TLT, and then like a 5-year bond ETF. And you can see that the shorter duration bonds move very little compared to TLT, which has these big, massive moves. And that's due to convexity with the duration. But because the shorter term duration, the treasury bills, because those are less volatile, they can be levered much more easily and created into new dollars, treasuries being the collateral for kind of the global financial system. So it's very pro liquidity. It's very stimulatory. I think inflation is going to pick up. I've been saying that for a couple months. And I think that the treasury bill kind of focus and the ease at which they can be so readily levered into new US dollars. I think it's very pro liquidity. The thing I would say though is I just want to know who's going to buy this negative 2.5% real yield treasury bill, right? Because Trump's talking about taking the federal funds rate from 4.3 down to like 1. Right? He's talking about just massive cuts in the short-term rates that would result in bills and shorter duration follow the Fed funds. And that would result, we're talking probably inflation's around 3, maybe even 3.5 or 4. So you're talking like significantly negative real rates. I just kind of want to know who's going to buy those. Maybe it's stablecoins. I don't know. But who wants to take a guaranteed loss where you're losing 2 to 3 to 4% per year in inflation adjusted terms? And we know, of course, inflation is actually higher than CPI, so it's even worse. So that clearly is their plan, right? And that's clearly I think the direction that they're heading. But yeah, for me, I just kind of want to see like who's actually going to end up buying those, because I surely wouldn't want to.
No. And you touch on like such great points here. Number one, like Bessent completely shifting face about the short end of the yield curve, like berating, yelling, like the Trump admin gets in, like they messed up the curve, and then silently, sort of implicitly, like recognizing, all right, maybe that was a good idea, continuing with it. But to your broader point, and this is something that did not get enough coverage last year, but funnily enough, Nouriel Roubini co-wrote a paper basically explaining why the over-indexing, or how the over-indexing on the short end of the curve is actually stimulatory. It's like stealth QE, essentially, in a way, in which you described, because you can take that short-term paper and sort of basically get dollars out of it and spend those or push those dollars into other assets. And so it's like stealth QE without saying Q. It's not the mechanics of QE as we know it, but I think the overarching point is like the system has gotten to such a point that politically you need to find those mechanisms to stimulate the economy, and that they're doing on the short end of the yield curve. And the other thing I wanted to bring up, I lost it, but like building on that that theme, it's the stablecoins, right? Like it seems like the Genius Act, and they're going to try, like, I think they're, I don't know how certain they are, but I think they're basically exploring all the options possible to drive demand to these things. And by really pushing the stablecoin narrative, which particularly here in the United States doesn't make any sense to me. Like I, as an American citizen, my bank account works well, Cash App works well. Then like I don't need stable coins, but they're really trying to make fetch a thing with stable coins. And I think what's underlying that is this need to drive demand for these treasury bills.
Yeah, they need balance sheet to financially repress. They need suckers at the card table. As Luke Groman says, they need to get those suckers at the card table to repress them. And look, maybe foreigners are willing to take a guaranteed 2.5, 3.5% loss to I'm not sure. I also think that it could weaken the dollar. I don't see how significantly negative real rates combined with a shift towards basically payday financing the government, and just fully admitting, yeah, we're in fiscal dominance, and we're going to run the turkey. Central bank has no independence, right? We're doing all the stuff with that, and the 1951 Fed Treasury Accord, we're basically reversing it, right? I don't see how like any of those things are bullish for the dollar. And again, I kind of got very bearish on the dollar, the Dixie, back in like January, and it was for a number of reasons. But we've seen clearly kind of a bit of a short squeeze. Positioning got stretched and whatnot. But I still think that like if you just look at incentives, and Bitcoiners are big on incentives, and we can see kind of through a lot of things by just looking at what are the incentives. They as much as they may say they want a strong dollar, they want a weak dollar. Going to the point of the current account deficit and trade and reindustrialization, we need a significantly weaker dollar to make any of this viable. A 15% tariff is not going to suddenly make American manufacturing cost effective for the rest of the world when the currencies are 35 or 40% mispriced. And so I was one of kind of the first people talking about like some sort of accord, right? Like that's kind of their only option, is to weaken the dollar, sort of like Plaza Accord. And the reason was, I think it was in like May or June of last year, Bessent did a speech at the Manhattan Institute. And as soon as I got done watching it, I watched it again. And I thought it was very notable that he mentioned monetary reordering 3 times during that speech. And he said something like, and I want to be a part of it, or something. I think that inevitably is going, if they're serious about reindustrialization, they're going to need some sort of accord And when it first kind of came up as a topic, it didn't have that Mar-a-Lago Accord name, like whatever it ends up being. Is it a Mar-a-Lago Accord or, the Hilton Accord? We need to weaken the dollar if they're serious about reindustrialization. And that, has consequences to it, right? Like all those cheap imports, all that cheap Alibaba plastic junk that Americans have been, piling up, that gets more expensive. But the good news is that over kind of medium to long term, high-paying manufacturing jobs hopefully come back. Now, I fully concede some degree of automation and robotics will make that difficult, right? Reshoring 5 million is out of the question, most likely. But even Bloomberg, which I take as kind of a pretty globalist leaning organization, even they were forced to admit, this was a couple months ago on the morning show, forced to admit that Apple, an assembly technician, right? So not a plant engineer, nothing crazy, not a supervisor, just a technician, US based. The salary was $112,000 per year. So, these are in the medium to long term, there is a world where inflation is rising at say 5 or 6%, because this will be very inflationary, especially if you mix it with negative real rates and all the bill dynamics. Both of those are inflationary, weaker dollar and that. So, there is a world though where inflation is 5%, but real wage gains are 8 or 9. And that's what I would hope to see, because going back to the silent depression stuff, like, the average hourly wage priced in gold has declined by 80%, going back to 2000. So just since .com, just since the Y2K and all that, just then since then, the real purchasing power of the average hourly wage has declined by 80% if you measure it in gold. And if you look at personal income divided by M2 money supply, that's fallen, I think, 30%. So again, in real purchasing power terms, the average American has been getting just decimated for decades. And a lot of the turning points in my chart happen to be that early 2000s. And I think it's not a coincidence that China was admitted into the World Trade Organization in December 2001. And that's when deaths of despair, like literally to the year, that is when deaths of despair just went vertical. And that is when, these measures of real purchasing power wages started to decline. And personal savings has been declining. So I would argue that, there are short-term consequences to a weaker dollar, whether that's via just kind of policy or via an explicit accord. Of course, there's consequences short-term, but, my hope would be that medium to long term, you would see kind of a definancialization of the economy and a return towards a much more net productive economy that is not, based around a bunch of people writing algorithms for high frequency trading firms, making, millions and millions and millions, hedge fund managers, right? But reorient around kind of actual useful productive capacity, because whether it's, kind of the medicine that I mentioned, 65% of active pharmaceutical ingredients, you look at chips and electronics, some of these key industry, like this is a national security emergency, in my opinion.
Serious about your Bitcoin? Start acting like it. Unchained just launched the Financial Freedom Bundle, a curated pack that includes a premium Bitcoin book, a new hardware wallet guide, and access to a private macro event with Tur Demeester, legend. It's time to take control of your generational wealth. Go to unchained.com/TFTC to request yours. That's unchained.com/TFTC. Pretty hot package, freaks. Go pick it up.
Yeah. And to your point, like, and I think I tweeted this out a couple months ago, but like, even if and when we reshore manufacturing, and even if 80% of it is automated by robots and AI, that's still preferable from the national security perspective that you're digging in here. Like, it should be made here. It should be overlooked and managed by American citizens to make sure that the quality is good, and that not only that the quality is good, but you're able to make it yourself. So you're not dependent on geopolitical adversaries. And so that whole sort of theme of like, oh, the jobs aren't going to come back, and even if they do, they're automated. It's like, I don't care if they're automated. Like, we should be making it here
is my perspective.
Yeah, and I have firsthand experience with domestic manufacturing. My family has had a company for I think 75 years that has manufactured goods in America, and like I think that there's a pretty large amount of kind of overestimation as well. I think a lot of people that are talking about reindustrialization need to go down, to your local industrially zoned part of town and just ask for a tour. Like, I know if it's our company, we'd be happy to, they love showing people around and what they do. I think a lot of people are kind of overestimating the degree to which automation will really play a role. Like we have a couple robots that I think they got maybe 5 or 10 years ago. There's some degree of automation, but like, I think people are overestimating the amount of automation. But to your point, even if 70 or 80% is automated, at least we are not reliant on countries that arguably at the turn of a hat, flip of a coin, might be our enemy. And like how are we, if we're so reliant on say China for kind of chips and electronic components for our own missiles and our own defense systems and our own ships and vehicles, like the minute we get into a war over Taiwan, which I hope doesn't happen, but like they just shut it off, as we saw them do with the rare earths. And like, yeah, it's kind of mind boggling that our leaders let it get this bad. It just makes you wonder, like, what, I mean, you can infer what the incentive was, but a lot of people got obscenely rich, and now wealth inequality is even worse today than the Gilded Age, which was so bad that we named an entire era of American history after how bad the wealth inequality was even worse today. So yeah, that was probably the incentive to do all this, but it just got to such ridiculous levels. It kind of makes you wonder, like, what were our leaders thinking? Because it was both parties, to be clear. So,
yeah, that's on the economic side. Then socially, you have like the rise of neoliberal, progressive ideals, and if you're a student of like Yuri Bezmenov and that interview he did in the 80s, like, have we been just under a slow rolling color revolution in the United States over the last 4 decades?
Yeah, well, I mean, look at trade is a great illustration of that, I would say. Globalization and the degree to which it was embraced at the expense of the average American. I would also point to immigration, right? We're talking economics. One of the key reasons, in my opinion, that the real purchasing power of the average hourly wage for the average American has declined so precipitously is both parties have, our birth rate has been declining for decades. And the way that both parties, up until Trump, of course, the way that both parties dealt with that was to import tens of millions of immigrants from other countries to come in. These are, willing to work for lower wages. And the law of supply and demand is no different when it comes to labor, that if you dramatically increase the supply of labor while demand stays constant or maybe slightly grows, 1-2% per year, whatever it is, if you increase the labor supply by 10%, wages must go down, just mathematically. And so that's another kind of avenue where you see, like, Reagan was the one that kind of started it, at least from what I can gather, with kind of mass amnesty back in the 80s. And look, like, multinational corporations benefited massively from that. Again, it boosts their profit margins, whether it's cheap labor here in America or cheap labor elsewhere. So there have definitely been beneficiaries. The other thing I'd point out that I think is really kind of interesting is, if you take the net worth of the top 1% and look at it as a share of GDP, so denominated in GDP, and then you overlay the balance of trade and you invert it, right? So it's the capital account surplus. It's almost a perfect fit, right? So the net worth of the top 1% as a share of GDP has basically been identical to an inverted trade deficit. So as the trade deficit has gotten larger and larger, the net worth of the top 1% and is increasing at a faster rate than GDP. When you do one of those relative charts, when the line goes up, it means that the numerator is increasing faster than the denominator. So the net worth of the top 1% isn't just growing with GDP, it's growing faster than GDP. As the trade deficit gets worse. So, there are very clear, beneficiaries to a lot of these policies and kind of the capital class, right? That Wall Street and those that own financial assets. It's the same thing with the housing market too. Like I'm a young person that liked to own a home. I worked really hard for 15, 16 years at a particular, career, climbed the ladder. And it's the same story with housing. If you look at that, the average sales price divided by the average income for a family, say, and again, overlay it with the trade deficit, it is a perfect fit outside of QE 2 and 3, where the Fed bought, trillions in mortgage-backed securities. But interestingly, when they engage in quantitative tightening, that it came right back down to where the trade deficit or the capital account surplus would indicate that it should be. So, whether that's a correlation without a causation, and that's just a spurious correlation, I'm not sure. But it's like the more of these metrics that I've been finding over the past year or two, the more I'm convinced that it's all kind of one trade, one story at the end of the day.
Yeah, the whole correlation is not causation thing. It's like it's like a way to obscure what intuitively to be true, but it's like so hard to like directly connect the dots that they're able to hand wave it. It's like correlation is not. It's like, come on, this is certainly happened. Like if you have two brain cells to rub together and you can think about second and third order effects, it seems like there definitely is some causation here.
Yeah, well, M2 money velocity, personal income as a share of M2, so real purchasing power of the personal income, S&P in gold terms, labor force participation rate, all of these peaked, money velocity as well, all of these peaked, around the same time. Average hourly wage in gold terms as well, also peaked in the early 2000s. So it's like, okay, I understand, contesting one of those or, two of those, but like I've presented so much data over the past year or two charts, right? This like, I just, it baffles me that people still try to dispute some of these things,
Yeah. And let's get into like silent depression and like something you said earlier, which is like, let's get away from financialization. Let's definancialize the economy, get back to a productive economy where people are actually working, building things, and not just creating sort of synthetic financial exposure to things. Because it's all connected. Again, in my mind, correlation is causation with a lot of these things. Like, you're not going to tell me that these things don't have effects on each other. And it's like, it's weird because we live at this time. My go-to example, whenever something like we are literally, you're on the other side of the country. I'm looking at my laptop. I've got my mic in my hand. We're going to distribute this on many platforms, and it'll be accessible to many. Like, it's inarguable that the tools that we have, the technology we have, is incredible today, and that's what they use. Like, hey, like things are great. Look at what we can do. But despite that, there is this silent depression. These divergences in the quality of life between the haves and the have-nots, and there has to be a better way, right? Like, I think we have all of this despite all of these things. Like, they try to use the fact that we have all these technologies as evidence that everything is all well and good, but I'm a strong believer in it could be much better. Like, we have all this despite all of that.
Yeah. I mean, look, it's great. Like I worked in healthcare. That was kind of my day job. That started working like very shortly after Lehman collapsed. And was doing my first interviews at like 18, around that time. So that was the start of my adult life. And I know a lot of millennials, especially Zoomers, right? Like, are kind of in this boat where, then we had, of course, the kind of prolonged great moderation, as they called it, but really kind of a lost decade of stagnant growth, very similar to Japan's lost decade. And then we had 2020, right? All the craziness of that. But it really, in my adult life, like, it felt like no matter how hard I worked, I kept climbing the ladder and getting the next better job, from the bottom to middle management, and then from there to basically right below the owner as a director, making a good salary, or what I had thought was a good salary. And like, just for kind of real concrete numbers that people can kind of wrap their head around, here, at least here in LA, in 2019, 2020, my salary of like $100,000 would have bought a starter home, a 70-year-old starter home, not in LA, but like in one of the kind of suburbs like the Valley, for example. I would have been able to do that. And I was looking at buying a home back then, and the income, I could make it work with interest rates being what they were. Well, today, that same house in that same neighborhood, not great neighborhood, not great schools, pretty high crime rate, 70, 80 years old, right? Probably needs some work. That same, I would need to triple my income to qualify for a mortgage on that same house. So, like, I understand why they changed the CPI calculation, but that's like a very real cost for a young person, right? Like, if the income needed to qualify for a mortgage on the same house increases by 200% in 5 years, you're going to tell me that inflation's only 21, 22%? Like, it just doesn't make sense. And I think the societal KPIs, antidepressant prescriptions, 13x since 1970, the suicide rate at levels, right, not nominal numbers of suicide, the rate per 100,000, that rate not being this high going all the way back to the Great Depression. That's the last time it was this high. Deaths of despair just going absolutely parabolic since 2000. We see it with like political polarization as well. Like, all these societal KPIs, all these like horrible events that keep happening in public, right? That, try and be careful, like, not to use bad words, but these things that just like every day we're seeing, people acting out in just absurdly violent ways. And there is this kind of like scream from especially the younger generations that just appears to be falling on deaf ears with the boomers. And if it was just deaf ears, that might be one thing, but instead it's generally met with righteous indignation, of course. But yeah, it's going to continue to drive all of those same problems until the actual issues are addressed. Wealth inequality will get worse, and therefore the kind of political polarization will get worse. We'll see racial divisions get worse. We'll see the political extremes getting more extreme. I mean, if, I've talked to a number of like, kind of average Zoomer men, and these guys are going to make Stephen Miller look like a moderate, right? Like, this is just a natural consequence of what happens when you default on the social contract. And I think that, until we really address the underlying issues that are driving these problems, all of the things that are bothering the average American person are going to just get worse and worse and worse. And I don't want that. Like, I want a safe, prosperous country. I want, my people to succeed and do well. I want a land of opportunity again. And look, to your point about technology, like, there are certainly certain advantages, I guess you could say, over the past couple of years, as I've kind of started doing all this, markets and economics and YouTube and all this various stuff. Like, it's a crash course for me in this whole new world that I didn't really know anything about. And look, like I'll be the first one to say that it's great. You know, I can spend an hour or two, you know, putting together a video, hopefully educate people, put that up on this website that people have on their phone, right? There's some really cool stuff. Like, I'm not trying to make it sound like it's all bad. But you know, it kind of goes the other way too, which is like, you look at the average Zoomer, the average young man, and what are they doing? They're gambling. Whether it's meme coins or sports betting, we've seen a dramatic increase in that. Like, the financial nihilism, I would say, offsets the benefits from, like, look, the internet's great, the kind of everything being connected, the world being connected, it's great, but like, it also enables these very negative and destructive expressions of, within technology, whether that's, the meme coin casinos and kind of all that craziness. I mean, I know a girl that just buys tech options every day, zero DTE tech, Meta, Nvidia, just buys calls every day. Doesn't know what a bid ask spread is, doesn't know what IV or delta or gamma or theta, just buys calls. Just totally gambling, right? Like, this is kind of the norm now with young people, is that without that 10,000x return, they feel like they're never going to get ahead. So just as much as the internet can be used in positive ways, right, responsibly, it also has, I would argue, offsetting negative sides to it too, which is it enables some of this gambling and kind of the financial nihilism piece, if that makes sense.
Completely agree. That's exactly what I was trying to get to as well. Is like this financial nihilism, the enablement of it, and this strive for yield, the younger generation specifically that feels like they have to play catch up and take obscene risk, is real, and it's having extreme negative consequences. Like, you're talking about deaths of despair. You brought up sports gambling. If you look at, it's not only affecting Zoomers, like, it's affecting millennials and Gen Xers too. Like, there was I think some FanDuel's getting sued by the wife of a guy who blew their $14 million trust because he was a high roller, and just, it's so easy to access that he blew 8 figures of wealth within a very short period of time. And that's, I think, the big question for me, and a lot of what I've explored over the years on this show and just doing introspection personally, is like, can this actually be solved via political means, or do you need something outside the system to actually fix it? And that's why I focus on Bitcoin. I do tend to sort of bend that way, and believing that you're not going to vote your way out of this. Like, you need to create systems outside of the terminally ill system that got us into this predicament in the first place. And to that point, like, do you view it that way at all?
Yeah. And like, with all this kind of, YouTube channel and all this stuff, the hunger and the degree to which it's resonated for someone who spent, 30,000 hours nerding out, digging into academic papers and Investopedia and TradingView and the Fed and all this stuff, right? Like, digesting it for normal people, the degree to which it resonated with just random, everyday, normal people, I was not expecting. So what I would say is that there's clearly, like, I underestimated the appetite for that sort of content because I think everyone knows that things are deeply, deeply wrong. It's just that, you shouldn't have to spend 30,000 hours nerding out in order to grasp some of these concepts and understand how your own financial system works. And I would say that, like, the Overton window, the discourse is shifting. A lot of people have been talking about the interview Tucker did recently with Werner, the economist. And that was actually one of the first things that kind of I did like a Twitter post or article on, was I had listened to one of his speeches at some university about Japan, and the fact that, like, that sort of discussion is happening on such a large platform, and I've had invites recently for kind of not Bitcoin channels, right? Not economics or macro markets sort of channels, but like much more kind of political sort of channels. And like there's clearly an appetite for discussion about economics and what's really going on, because part of the problem and what I always try to do is, if you just look at the average hourly wage, which is what you hear reported on the nightly news, the line it looks great. It's up and to the right. It's kind of even parabolic. You would think everything's great. Well, you got to go a couple layers deeper, right? Like all these numbers that they're reporting to the American people, it's like they're sitting there, getting home after their third job, right? Using a firm to pay for groceries, hearing the nightly news talk about, oh, unemployment's only 4.1 and GDP grew at 3%. And they're like, huh? Like what I always say is, what good is GDP if the average hourly wage or personal income is not keeping pace? So yeah, like, certain things have outperformed, of course. Government debt has outperformed GDP. That's why government debt to GDP has doubled, right, in the past like 40 years. The net worth of the top 1% has also doubled as a share of GDP over the past 20, 30 years. And then you look at like financial assets, the S&P 500 just radically outperformed GDP. A stat that I think is really telling to the hyper-financialization and the K-shaped economy is if you take the S&P 500 divided by the average hourly wage, what you get is the number of hours needed of work at the average job to buy one share of the S&P 500. And it goes all the way back to the 60s. And the average when my parents were coming of age and working was like 15 to 20 hours of work at the average job to buy one share. Now that number is 200, right? So what that indicates is that the S&P 500 has increased 10 times faster than the average hourly wage, right? So those that hold financial assets, those bureaucrats that have benefited from a massive expansion in the size of the federal bureaucracy, the top 1%, right, that own all these assets, they are doing better and better and better. And people see that. Like they might not know the stats, right? They might not be able to kind of conceptualize it, but they feel it and they see it and they know it. And so I would say that like the benefit or the side of me that's optimistic is that there is such a growing kind of recognition and willingness to talk about it, even on the right wing, right? Which, I mean, both parties were equally responsible, in my opinion, for a lot of the globalization, a lot of the things we talked about. But, historically, when I was younger, started paying attention to politics, it was like you couldn't talk about wealth inequality or corporate profits greatly outpacing GDP. That's another one that's outpaced GDP growth. Like you couldn't talk about those things. Well, now, not only are you getting it from the kind of Mamdani side of things, but you're having a willingness to talk about it even on the right wing. So like that, to me, that's a positive sign, because that's kind of the horseshoe theory in action. We're seeing that on a political level, at least there's a willingness to talk about it. Now, to your point, whether or not the solution ends up being a political one, I'm not so sure. But I would point to, I think that I'm seeing more and more of a discussion around the struggles for young people, the structure of the economy, wealth inequality. I'm seeing more and more discussion about it. Like just over the past couple months, it seems like it's just absolutely gone exponential, which for, someone who was like the old man yelling at the cloud about it for 2 years, it's really like, it's good, because I feel like, I didn't do that much, right, to actually hopefully, advance it. But it's like, it makes me feel a little bit more validated that like, okay, at least like everyone's kind of talking about this now, because we're not going to be able to get to a solution unless everyone knows what the problem is.
That's an incredible point. It's funny that you mentioned that, because literally I recorded an episode this morning with Zuby about this exact topic. He wrote a Substack piece last week about like 12 pieces of advice for Generation Z. And we walked through that. But like the whole point of his article and our discussion about the article is to sort of transfer knowledge to the Zoomers of like, hey, we're a generation ahead of you. Like, here's exactly what's happening. You guys need to understand this, and here's how you should operate with that understanding. And I completely agree. Like the recognition of the problem is greater than it ever has been for somebody who was radicalized by the great financial crisis. And like the timing for me personally was perfect because I was a senior in high school. It affected my dad, my father's career, and sort of engendered me with this spirit of know your enemy. So I went and studied econ, and always, even when I worked at a fund and was doing like sort of tradfi world things, in the back of my mind was always like, this system's broken. I need to figure out how. And ultimately found Bitcoin. I was like, all right, this is what I think is a key part to the solution of solving these problems. But back then, it was like an island. I was that crazy Bitcoiner. 2013, 2014, people were like, shut up. And now, it's not Bitcoin specific, but I just think, to your point, the recognition of it's because it's like it's gotten to the point where it's impossible to ignore. Yeah. And it sucks that it had to get to this point, but you can only solve a problem if you recognize that it exists in the first place.
Yeah. Yeah. And like, if I had to give one piece of, or maybe two pieces of advice for the younger folks, like, I think it's hard for them because we as millennials, like, you know, when I was climbing the corporate ladder and, you know, trying to get ahead and stuff, I could look to the Gen X, right? The generation ahead of me. They had the, you know, nice car and a house and the kids and a good salary that they were comfortable on. You know, I think what is part of what the Zoomers have that is so difficult is they look to us. They look to the millennials, and we're like directors making $100K a year and right, like not having any of that. So they have it. They don't have that like optimism, right? Like at least I and a lot of the millennials I know, we could look to the Gen Xers for kind of like optimism or hope. But the Zoomers don't have that. Like all they know is bad. And if I were to give two pieces of advice, it would be trades, right? Like I think that, you know, the Wall Street Journal did an article like the next millionaires wear tool belt or something like that was the title. And I think that that'll continue to be a trend that some of the highest paying, most successful people, especially if we definancialize with a weaker dollar, some of the best industries for a young person to make a living in will be trades. And even now, like even today, they're making like hundreds of thousands of dollars. I know a guy that drives a GT3 and he's like, he puts in pipes. Like I still don't really understand like what it's probably more complex than that, but he basically like digs holes and puts pipes in. He has a GT3, you know? So like it's already kind of at that point. So I would say trades, you know, the traditional 4-year education, I think is a scam. And I think it's dead and gone. And then I would also say, of course, save in scarce assets like Bitcoin that will preserve your purchasing power and hopefully continue to outpace the amount of kind of currency debasement that I think, you know, I think most of us are, whether it's Larry Lepard with the big print, I don't think it'll be that big. You know, I don't think it's one big print, but I do see kind of a higher inflation period of, you know, regime that we're going into. Scarcity is the antidote, right? So like, you know, or as Jack says, you know, don't work for money that another man can print. I think that's great. And so, yeah, you know, saving your time and energy and your labor in an asset that cannot be inflated, cannot be printed. I think that that's another critical. I mean, if I had done, I came across Bitcoin in like 2009, 2010. If I had even put just 5% of my kind of average, you know, weekly earnings in a bit, I would be insanely rich, like insanely rich. I didn't know what I had back then. I thought it was just like a, you know, internet money thing. And I would, you know, it would have a little run up and I'd think, oh, great, I'm rich. You know, that was great. Sell it. So I didn't really know what I owned until recently, unfortunately. But I think that, you know, the antidote to an overabundance of fiat currency units is scarcity. And Bitcoin, we know, has one of the lowest supply increases of any asset. So when it comes to the scarcity side, it is one of the more scarce assets that you can own, even now more than gold. So,
yeah. And like bringing this back to how do these overarching problems get solved in the long term? Like I'm a big believer that Bitcoin can lead to the great definancialization. Parker Lewis's blog post and ultimately a chapter in his book Gradually and Suddenly about the great definancialization is something that I truly believe in, something that like 1031 we're investing behind. Like obviously you were just talking about the individual saving scarce assets like Bitcoin, ideally, but I think inarguably, if you look at all the scarce assets, Bitcoin is still going in the very early stages of its monetization phase and has the highest upside. But then in terms of like actually beginning to definancialize the world and sort of manufacture a soft landing in the long term, I think Bitcoin needs to be injected as collateral in credit structures. Like you need to refinance the existing pools of credit that exist out there with better collateral. And to what you were saying at the beginning and throughout this conversation, really, is like we've seen the financialization people are the people who understand what's going on and want to outpace inflation. They're pushing it into real estate, into stocks, into financial assets. And now an alternative exists. Like instead of basically putting money in a house and using that as your long-term savings vehicle, you can put it in Bitcoin. And now we're getting to a maturation point of Bitcoin's sort of development where you can sort of replace, instead of taking out a mortgage on a house and just using the house as collateral alone, you begin to dual collateralize it with Bitcoin. And at that point, you're not really wholly dependent on the equity value of the house. You have the Bitcoin collateral in it as well. And to me, I could be wrong. I'm very interested to get your thoughts on it. Like that's how you manufacture a soft landing from the private sector, and you're not beholden to the whims of the political apparatus and the ping-ponging that goes on there.
Yeah, and Luke Luke Roman was way kind of the out ahead of this concept, but they need something to inflate, right? And ideally, that is a kind of it's not a commodity that's needed as an input in critical industry or global trade, right? So you need kind of an asset that can absorb some, because we know financial repression is coming. We know it's really the only way out of a 7% procyclical deficit, with interest expense eating up 20% of tax receipts and mandatory spending over 100% of tax receipts. Like it's getting to a point where we know the only way out is to inflate the debt away, run it hot, whatever term you want to use. And Bitcoin emerges as a perfect asset because it's small, right? To your point, it's still early days. $2 trillion is a lot of money on the one hand, but when you compare it to, say, gold or equities or certainly bonds, it's still relatively young, very young. So it offers kind of an escape valve for the coming financial repression. And Luke, was kind of the first person to frame it that way. And I think it's a great way to look at it. I would say, like with the young people and Bitcoin versus homes, the only kind of pushback that I usually kind of think of when I hear that argument in the Bitcoin circles is the real secret with housing is that you get insane leverage. So, you go and put 10% down on $1 million home. And, when that $1 million home inevitably doubles over, say, 5 years, 6 years, you get the equity of the whole home, right? You can then tap a home equity line of credit for 2 million to, however much was, right. So your equity is the entire value, right? Even though you only put up 10%. So the leverage is really where like owning a home builds wealth. Like it doesn't actually build wealth because the home price is just going up as the currency is debased. But in dollar terms, like that leverage is really the secret. Now we know Bitcoin has an insanely high CAGR, so it could be the sort of thing where Bitcoin continues to appreciate a 45, 50% CAGR. I think that would be enough to offset the leverage side of that's why I always say like home ownership and the wealth that you get. What it really is just levered exposure to currency debasement. The house goes up, it's an optical illusion. The home price goes up as the currency is debased. You have a large amount of leverage, right? And can then, tap the equity. So, if there was a company that came out to offer like Bitcoin mortgages, that would, I think, be probably the single best thing that could be done, because then you're getting the benefit of leverage and the Bitcoin's appreciation, and that's where the young can really kind of get ahead in a quick way, because that's really what the home situation. That's really what it is. It's just leveraged exposure to debasement, and because Bitcoin, I mean, you can get leverage with Bitcoin, but it's not as intuitive, and it's certainly not as large of an amount of money. Like, no one's going to give some Zoomer that's got $5,000 of Bitcoin. No one's going to give them, crazy amounts of leverage. So, in a 30-year structured product like that with a relatively low interest rate. So yeah, I think I've heard people saying we want to create that sort of product. And like we were both saying, it's early days, so maybe something like that comes along and is able to kind of really accelerate the degree to which the young people can get ahead.
Yeah, and it's not catered towards young people at all, but we invested and sort of helped incubate this idea of battery finance, where they're starting out focusing on commercial real estate, which is a market that desperately needs more creative financing options. And they basically go and find high grade properties that are sort of at their pick of the litter, refinance, give them the cash they need to pay off their original mortgage, a little cash for improvements if they need it, and then a chunk of cash to put into Bitcoin that sits in the loan structure. And just having been close to the development of that product, like I'm wholly convinced that like this is the way you manufacture sort of like a transition from aping your leverage and your sort of savings and value into real estate and begin sucking it into Bitcoin. Will start like dual collateralized, and then hopefully over the long run, like these assets that really aren't optimal to be stores of value, long-term stores of value, because they have other use cases, consumable use cases that more people should have access to. That's how you get them to reprice to what I would argue is like a real price for these assets.
Yeah, and the thing I would say about Bitcoin in particular, like kind of going to what we were talking about with the direction the Fed and Treasury and all that is going, I would say that in a world where there's basically a political puppet as Fed chair, and monetary policy is now a political decision, I would just say for those on the right that support Trump and all of that, just imagine a Biden-controlled Fed, right, where everything about monetary policy was a political decision. I don't personally think that that's going to be very good, no matter who is in charge of it. And I think that as we see that kind of go the emerging market sort of route, probably higher inflation and a worsening of the K-shaped economy as asset prices really kind of take another leg higher, all the dynamics that we've been talking about today. I think something like Bitcoin emerges as what's so cool for someone who's so immersed all day in macro and markets here in US and Europe and Asia and all this stuff, following every word of every Fed speaker and watching every bond yield in the entire world. What's cool about Bitcoin that I keep coming back to, that I always tell people, is look, the monetary policy of Bitcoin. The monetary policy of Bitcoin today. 6 days from now, 6 weeks from now, 6 years from now, 60 years from now, the monetary policy of Bitcoin, and these kind of bearer assets that are neutral, right? This ability for neutral reserve asset that a lot of people have been talking about. I think that the appeal of that is going to grow, just generally speaking. I think corporations, I think in the real estate sector, I know Grant Cardone is doing a lot of cool stuff with Bitcoin and real estate. I think on the individual level, right? There's so much chaos and kind of instability and all this kind of stuff. I think normal people, the emergence of an asset where it is so predictable. You know exactly what the monetary policy of it is. It's consensus derived. It's hard coded in lines of code that are, confirmed and secured by the strength of the network, which keeps growing. All the properties of Bitcoin that Bitcoiners talk about, I think, are going to start to really become appealing amongst kind of normal people, if that makes sense.
Yeah, it's this anchoring mechanism. It gives you a high degree of certainty in an incredibly uncertain world, right? And like if you can, I think that's just like when you get to like first principles Austrian economics perspective of Bitcoin, like that is the sort of stabilizing nature of the asset. Is like, and then conversely, like why everything is so unstable is because you have an inability to know at any given point in time what's going to happen with your money, because it's centrally controlled. Once you can have certainty and anchor into that certainty by using Bitcoin, you can then begin to coordinate economically with a higher degree of certainty, and you can take less risk, and you don't have to financialize everything to get a return. Like, I think, succinctly put, first principles Austrian perspective of Bitcoin, that's what it does, right?
Yeah, and it's also outperforming so many other assets, right? Like the first thing I do when I see someone, advocating, oh, buy this stock or buy this, the first thing I do is just divide it by Bitcoin. And it's almost always just down and to the right. You know what I mean? So it's like, it's outperforming the vast majority of assets. Like, yeah, over certain time frames, you can find, some tech stock that whatever, but like the vast majority of people don't have the skill to be stock pickers. So like, it's very simple. It's very straightforward. You just buy it and hold it, and it goes up. And it goes up forever because the dollar has no bottom, right? There's no top in the Bitcoin price because there's no dollar on the bottom. There's certainty with what it is, how it works, the monetary policy, right? The new supply, all of those things. And I would also point out that like since kind of the TradFi adoption, which at first I was kind of like knee-jerk reaction was negative, because the whole reason I found it in 2009 or 10 or whenever it was some like anarchist blog spot, right? And it was like the cypherpunk ethos and the kind of, revolutionary sort of side of it. And like, so then to see it kind of, be adopted by like BlackRock and this, it was, my first reaction was negative. But now that I've had some time to kind of, really think about it, it's really decreased the amount of volatility that we've seen. It's almost like, Bitcoin pre ETF versus after ETF has been just a different thing. And I think that, to your point with the stability, I think that the lack of that volatility as we build, derivatives complexes on top, and all these different products are offered, and it becomes a bigger market. I think that we'll see less volatility, and that'll encourage more inflows, right? So it becomes a
strange game where the only winning move is to play. I completely agree. Like I had similar aversions initially, but now when you see it, like I do, it would be naive to think that there aren't going to be some actors in the traditional financial system getting into Bitcoin in size that make mistakes, get over their heels, get over levered, ultimately blow up. But I think in aggregate, the most important thing of this wave of adoption is it's growing the number of different archetypes of demand for Bitcoin. And I think we're getting to a point where there's so many different demand drivers, whether it's an individual looking to outpace inflation and save their value in an asset that can't be debased, or a company that realizes, a private company, small, medium-sized business that's profitable, is run by a Bitcoiner who understands that if I'm profitable and I'm skimming some of those profits into Bitcoin, is going to be good for the equity value of my business. You have individual states who are saying maybe we should have a state level Bitcoin treasury. You have obviously countries doing that. And then you can see, going to like Luke Roman's thesis of a Mar-a-Lago Accord or something like that, probably won't happen this administration, but at some point down the line, I think at the geopolitical level, it's going to be impossible to ignore that this neutral reserve asset that nobody can control is optimal and preferable to this sort of system of barter that exists in FX markets.
Yeah. And like I would say, we saw a very early glimpse of what the dollar trading on a balance of payments basis looks like. We basically saw kind of the early stages of a balance of payments crisis in that right after Liberation Day. We're in a tricky spot. Like there's not a ton of room to really navigate politically. Because this NIP is negative 100% of GDP, foreigners own tens of trillions, of our assets. They have us kind of, they can control us if they don't like a particular policy. So ultimately, like you have to get to the root of the problem, which is kind of the structure of the system. And I would say that, nations, if I was a current account surplus nation, either in the Middle East or Asia, traditionally it was you put your those surpluses into U.S. Treasuries. People say the dollar, but really it's interest-bearing dollars like Treasuries. Traditionally, because we were in the secular bull market, that was a good move. But it's not a good move, right? Like that bull market, secular downtrend in rates. We've broken that in 2022, and I like Peter Turchin and Neil Howe and those demographic guys, and they talk about these long interest rate cycles. And if you look at all the structural drivers of inflation, and kind of if you look at negative catalysts for sovereign bonds, you just go down the list. There's like half a dozen. Catalysts, whether it's deglobalization, whether it's the fiscal side of the kind of the government's balance sheet, whether it's kind of a move in a different direction in regard to immigration policy, that's also inflationary, just as increasing the labor supply keeps wages suppressed. The opposite is also true, right? So you'll get inflation driven by wage gains. So yeah, you just go down the list and it's like, it's all bad for bonds, And so I think that long interest rate cycle, I think there's truth to that. Now, they could always do yield curve control, right? And just totally nuke it. But I think that the bias is towards higher rates, especially at the long end. I mean, we've seen since the Fed started to cut rates, prior to the last election, they cut by 100 basis points and the 30 years up 90. Like it went in the opposite direction by 190 basis points. Of course, it wouldn't be 1-to-1 on the cuts, but it went in the wrong direction. And since the cutting cycle began, we've been in a bear steepener. Now, today there's a big kind of bid into bonds, especially the short end because the NFP was weak. But yeah, like bonds, just especially long term, duration. Like I don't see how it's appealing to all these current account surplus nations, especially after we did what we did to Russia, where we basically just turned off a bunch of QSIPs, and defaulted on treasuries that they rightfully owned. Like
what was it? 200 billion?
Yeah, it was 100. It was over 100 billion. It was a lot of money. And so, yeah, it's like, the appeal of something like Bitcoin, if I was, an emirate country with a lot of oil running a current account surplus, like it's perfect. It's a bearer asset that's not centralized. No one can control it. It's scarce. And it's easily divisible, easily transportable, like all the properties we know. And it'll hold its value, because if you're a current account surplus nation, that is really the purpose. That's really your goal, is to, you're accumulating national savings via that current account surplus. You're trying to store the value of those savings. And Japan did it in U.S. Treasuries. They also bought a lot of real estate, of course. And I think that there will be on the margins those, a shift towards Bitcoin. It's not going to be like, 20% of current account surpluses overnight get put into Bitcoin. But around the margins over the next 5-10 years, I think it's inevitable that we will see that kind of start to grow and really just, around the margin, slowly but surely, very gradually, stable sort of increase. I don't think it'll be violent, but you never know if there's a black swan event that just collapses trust of the system. You could see, I think you could see a little bit more of a dramatic move into Bitcoin from not just nation states, but people, corporations, and everyone involved.
Yeah. Yeah. When you think about long-term bonds, particularly the 30-year, and then people like Chamath saying we should do a 100-year bond, a 50-year bond. It's like, take a step back and what are you doing? You're literally lending money, and your counterparty has proven that they spend that money terribly, and they're only racking up more debt. They're tapping the credit line, the revolver, more and more every time. And 30 years is a long time to take that risk. So why, when you have alternatives like Bitcoin, would you ever take that risk? And then you pile in the sort of geopolitical situation, the fracturing, the bipolar, multipolar world that is manifesting before us. And it just doesn't make any sense at all.
Yeah. And look, listening to the power centers like the Fed and Treasury, it blew up regional banks, right? They listened, they bought all those really, really, long duration Treasury bonds. And, as soon as rates started moving higher, due to convexity, those 20, 30-year bonds just collapsed in value and, ended up taking down, some of the, I think it's 3 of the largest 4 bank failures in U.S. history occurred during that time period. So, yeah, it's just, I could not be more bearish on long-term bonds. There's no world that I could ever see where I would. Now, as Jim Bianco says, there's no bad bonds. There's only bad bond prices, right? If the thing was yielding 50%, right, like some emerging market bond, then I don't know, maybe I would buy a 30-year Treasury, but then you get into the interest side too, right? Which is if you take all of our marketable debt, the average interest rate on all of our marketable debt is 3.3. As of yesterday, there's nowhere on the curve where you can issue at 3.3, which means interest expense will only continue to go higher. If they are not able to kind of gain control of the Fed and really force rates down through mega dovish forward guidance, interest expense is only going to go up. And so, you get into a situation where you're stuck. I think that they're very close to admitting, look, it's fiscal dominance. Can't blame us. It wasn't our fault. We just inherited the situation. Here's what we got to do. We got to run negative real rates. I think what I was saying last year that I think would be smart is to strategically, we know they need negative real rates. Use those negative real rates strategically to help domestic industry. Right? Use it as create some sort of structure like Japan had. They might still have that. I'm not sure, but some sort of way to try to approach fiscal and monetary policy and meld it with industrial policy, domestic industrial policy. I think, look, maybe, people might think that sounds like very anti-American, but if we got to run negative real rates and financially repress the bondholders, shouldn't we at least be doing it, using it as a benefit by cheap financing for things that we need, like critical infrastructure and defense and all that?
Yeah. Yeah, I'm thinking here. I could certainly I guess the point I would make there is if you have to do it, and you're trying to optimize for optimal outcomes for American citizens, that makes sense. But what I would worry about, particularly when it comes to yield curve control and building on a point we made earlier, is that more, you're seeing it with your channel, more people are hungry for this, they're recognizing it, and it sort of seems like it's a foregone conclusion in many circles that yes, implicitly, it's very implicit right now. It's not quite explicit, but it's beginning to become more and more explicit by the day that they want to sort of officially eliminate the independence of the Fed, tie it in with the Treasury, and go towards the Japanification of sort of the Treasury market. And I totally believe that's their intent and their goal and what they're going to try to do. But I always wonder, we have we can just look at what it's done to Japan since the 90s, and it's arguably not good. Going back to like silent depression, like in Japan, like it shows up there in the fertility rate. Like they're going to have population collapse, and I just wonder socially if enough people become privy to, we're doing what Japan just did. Let's look at Japan and see how they're doing societally. Is that optimal? And people say, I don't know if we should be doing that. Like, does that throw a wrench in the yield curve control plan? I don't know.
Yeah, I mean, I looked at one of the videos I did looked at like the World War II, right? The last time we've seen this sort of thing, and inflation was like 18% during one of those years of yield curve control. And granted, it was, wartime, and there's, we were industrial economy. It's not a one-to-one thing, but like, yeah, there's certainly consequences to it, for sure. And like I just don't see how we don't have, higher inflation for the next decade, or maybe even more. It depends really on like how negative they can get the rates, and how far below nominal growth they can get those interest rates, or the average cost of the debt. That I think will determine how long they will have to run, the particular regime. But yeah, it's not there. What I always say is like, you can't defy financial gravity forever. America tried to defy financial gravity for decades and was successful. And, at some point, like the bill comes due. And there is no easy way out. There's no painless way out. There's no way out that is just perfectly, risk-free and without consequence and pain, due to, like accumulated policy decisions by the prior generations. So yeah, it's going to be volatile. I think it's going to be unstable. It's going to be uncomfortable, probably. Generally you don't want to see monetary policy become a political tool. Like Turkey did that, right? Erdogan did that, and they had 45-50% annual inflation. And the price of gold in lira is like the craziest looking chart, when he started to really make it a political organization. So now, of course, we're not Turkey, but like it's not going to be without consequence for the U.S. And I just, I feel that sentiment building, that like people know something's not right. I think people also know that like something's coming. There seems to be this really pervasive sense that I get from like reading comments and stuff of people like feeling like there's something right around the corner, like some shoes got to drop. And maybe it's all, I hope it's not war. Maybe it's all this kind of stuff, negative real rates, yield curve control. They probably won't call it yield curve control. Like, I think if they end up going down that route, they're going to make an effort to make it sound as different as possible from Japan. Different names, different acronyms, different terms. But like, yeah, with one of the silent depression kind of pieces that I did looked at total bank loans and leases, right? And this is what drove private bank credit creation, was what drove the post World War II kind of booming American economy. And if you look at like total private bank loans and leases divided by M0, the monetary base, which is that government money, private bank credit just fell off a cliff in 2008 and like hasn't recovered. And this is something that Warner was talking about with Tucker in that interview, is that where the funding is going can be just as important. Well, if we're going to just, if the banks are going to, create private credit creation, but it's going to like securities purchases, like that's not going to benefit most Americans. And in fact, if you look at GDP divided by M2, we had GDP growth outpacing the money supply, again, up until the late 90s when that turned over. And we've been getting negative returns for each new dollar of debt that we print. We're getting less and less actual GDP. And it's the same story if you look at it, the GDP divided by the debt. And GDP outpaced debt growth up until I think it was 82. And then in 82, 83, in the early 80s, it rolled over, and we have been getting less and less return on each new dollar of debt. So they got to do something. And if there is smart policy that can get that side of the economy, the bank and the lending side, to somehow direct into more productive, like you start getting into uncomfortable conversations though, because like, what if you take that one or two steps further, that's like, socialism or some pretty ugly
of industry.
Yeah, like you get into some uncomfortable conversations, but like, and to be clear, like I don't support, a lot of that craziness, but like, I think that there is a way that we can, Japan had that, right? That was one of the things that they had, like the trade and industrial ministry or whatever it was. And it coordinated with, and look, like Japan did great after World War II. Up until kind of the bubble started, they were doing amazing. I mean, they thought there were people here in America that were worried that Japan was going to overtake America. Like this tiny island country was going to overtake America. So like, I think that, free markets are generally good. Generally the side you want to err on. But I think that like to ignore any and all evidence that to the contrary, I think, like Japan made it pretty clear that like the average Japanese person from call it, 1960 through to 1985 did really well. And the economy as a whole did really well. I think, even Howard Lutnick is calling for some of this kind of much more like not typical conservative stuff. Like he did that interview with Pomp where he was talking about basically nationalizing the defense companies, right? So this is not the Republican Party of my parents, right, or my grandparents. And so I think there will be some degree of coordination to try to direct much more productive lending, because I think that's a big story. I mean, if you look at that, private bank credit creation, if you look at it as a logarithmic trend, it fell off in 2008 and it's just been just anemic going sideways. And I think it's a big problem. And Werner was very on point with his discussions about it.
Well, and you're seeing the product of that be the manifestation of all these private credit funds that are spinning up to service this market because the banks either won't or can't for some reason.
Yeah.
And last question, because this is a big meme and part of like we're going to grow out of this. Like, do you have any hope or optimism about like the productivity miracle provided by AI? Like, is this a silver bullet, the black swan that we're getting handed?
It's possible. I am not the biggest, like just on a personal level, I try not to let like my personal beliefs or feelings influence like my analytical, right? But just on a personal level, like I'm much more in the like, get me a cabin in the woods of Montana, right? And like I'm not one of those like tech accelerationist sort of people that is like begging for the singularity and all this craziness. It's generally not kind of who I am as a person. So that being said, my bias, being clear, I don't think that it's very likely. I think it's certainly maybe 10, 20, 25% likelihood that you see productivity. But as Luke Groman points out, and it's what he says, I have found as well through like looking at it independently, it would have to come at the right pace, not too quick, not too slow, and just the right amount. Like, because otherwise, if it comes too quickly, you're talking about, I don't know, 20, 30, 40% unemployment. If you throw robotics in there, you could see such massive disruptions. And then how do you fund the UBI, right? That ends up becoming necessary for that in that world. Some people say, look, for every job that's lost, one will be created. I don't fall into that camp. I think more jobs will be lost than created with this, especially once you throw in robotics into the mix. So yeah, I think that, we know how inefficient the government is, and the cost of administering some of these social programs. I did a post maybe last month that looked at Medicare outlays, Social Security outlays, and VA outlays relative to tax receipts. And I think it was Medicare has grown 7.4 times faster than GDP or tax receipts, going back to 1965. Social Security, I think, was 3.4%, 3.4x faster, 3.4 times faster than GDP or tax receipts. And VA, I think, was in the low threes as well. So government programs kind of by definition aren't efficient. So if you have high unemployment, it'll take money to then administer the programs that do all the UBI. So you end up talking about like even more money, and then you ask
inefficiencies.
Yeah, and like you ask the question, or I asked the question for tech stock kind of people, like, how are you going to fund that? Right. The only way that I see that being funded is by just like massive taxes on Google and Meta. Whoever has those tools, just massive taxes on them, and then it's like, well, why own the NASDAQ?
Yeah, well, and then also to that point, and I'll put my bias out there. Like, I'm probably more optimistic because I've just like we've been leveraging AI here, and it's made us more productive, and I haven't fired anybody for it. I've just like equipped people with it, like extend your capability. But to your point, like I think it's very unclear, like how many, if any, of these companies are profitable yet. Like, I think that's the big question. Like, how much cash are they burning behind the scenes? Like, how much of this is just like an attempt to try to create enough energy and attention and adoption to try to get to profitability? But like certain companies, at least, I think it's pretty clear they're burning incredible amount of cash and not getting
huge amount,
any return in terms of profits. And it's like, have we reached a point where these companies can actually do it profitably yet? Like, I think no. And like, will it ever manifest? Like, I think that's a big question.
Yeah. I mean, I would say like I at first was like very opposed to adopting AI just myself. But then I was like, no, I'll try it out. Right. And so I kind of started like tinkering with it. And I got to say, like, I've come around personally to AI. Like, I was one of those people that kind of hated it in the beginning and was very skeptical, but it's helped like immensely for kind of like, I can throw into it some complicated, I can say, country XYZ has a current account deficit, they're running a fiscal, right? Like give it all these conditions, all these kind of like inputs or variables, and then ask it to interpret how a particular policy on this side can like the degree to which it can think beyond my capacity so quickly has enabled me to it's helped me a lot, and of course it helps with like little things like help me write a introduction to my video, right? Like stupid stuff like that saves you time, and so then that's more time that I can spend reading academic papers at the Fed or whatever. And so I do think I'm not trying to say that it's like a horrible thing. I think that the productivity, I think that, if people are skeptical of it, I would encourage them to try to just adopt it. It's not perfect yet, of course, but like I was one of those skeptics, and I got to say, like it's been a massive boost for just a single guy that's trying to do all this, YouTube and Twitter and right, all this stuff. It has, massively benefited.
Yeah. Fun times, exciting times. You optimistic, pessimistic?
I'm optimistic. I think, I see a spirit of that's kind of reemerging, especially amongst like younger people. Beneath the anger, beneath the resentment and hopelessness and despair, like there is this kind of bubbling up of this is the first turning that Neil Howe talks about, and I think we're certainly in a fourth turning, and it's certainly I think the next couple of years are going to be very volatile, very unstable, uncomfortable maybe, but like the benefit is that coming out of this, we are going to have such a golden age of American exceptionalism that I think, might even surpass kind of the last golden age of America after World War II. And so that part gives me hope, and I would say for the people that like are worried about where we're at today and where, the volatility and the chaos and this and that, I would just say like, just try to weather through the storm, because I do have hope that it gets better. And, that's what history, that thousands of years of history, right? Like Peter Turchin goes back like hundreds and hundreds and hundreds of years and finds the same cycle. So, like the inevitably kind of coming out of this fourth turning will be, a golden age unlike any other, because now we're going to have tech, right? And look, one of the things to say about America is like we by far have the best tech companies and the best kind of innovation. So that's a positive. And yeah, I think definitely medium to long term optimistic. Short term, it could be, but you just got to like weather the storm, right? Like don't do anything stupid. Don't use leverage. Just kind of keep it simple and just hold on. And I think, 10 years from now, things will be a lot better, hopefully.
I agree. And that sort of energy that you're describing, it feels like for a period of time, particularly post 2000, there's been a lot of complacency. Like we were given, like us as millennials, we were given the roadmap. Like you go to school, you get your 4-year degree, you get a job, and it's done. A lot of us went, I didn't do it, but like a lot of people, I went to college, but like I didn't like stick to a career because I had basically sniffed out pretty early, like, this doesn't seem like the right thing to do. But many of our generation did, and are recognizing like, the roadmap didn't lead me to where I thought I was going.
Yeah.
And I think particularly with Zoomers and millennials that are privy to what's going on, like yourself, there's a degree of agency that's reemerging where it's like, I'm not just going to take the roadmap and basically use that for my life. Like I'm going to try to figure out and actually understand things and make my own way, which is incredibly encouraging.
Yeah, it's the weak men create hard times, and hard times create strong men create good times. It's kind of, it sounds stupid, but it's kind of the pattern that I see as well.
Yeah. Robert, this was incredible. Where can people find out, where can they find your work on YouTube?
Yeah, on YouTube, it's Infranomics, INFRA nomics, like economics. And then on Twitter, it's at Infra, INFRAA _, and I have the blue check. I guess I'm at a size where I get the imposter. So just make sure it has the blue check and the underscore at the end there. And that's basically most of where I am. I do spaces and stuff. So I try to respond to all the comments on YouTube. So try to engage with people as much as possible. If you ever want to talk, come to one of the spaces we're in and just hang out, ask your questions, talk.
Hell yeah. We'll link to all of that in the show notes. We should definitely do this again. This was fascinating.
Yeah. It was a great time.
Awesome. All right. That's all we got today, freaks. Peace and love.
Decay. Freaks, thank you for listening to the show. I hope you liked it. If you did like it, please make sure you subscribe, rate, review the show. It helps us out a lot. And also, if you like these conversations, I've come to realize that many people listen to the podcast. They don't know we have another sort of layer of this media company. We have the newsletter, the Bitcoin Brief. Go to tftc.io. Make sure you subscribe there. A lot of the topics that are discussed on this podcast, I write about 5 days a week in the newsletter. We also have the TFTC Elite tier. If you sign up for that, become a member. We have a private Discord server for the elite freaks out there where we're dropping ad-free versions of this show and having discussions about everything we talk about a day early. Logan wanted me to make sure if you want to get the show a day early, become a TFTC Elite member. You will get that. We have our Discord server. Right now it's conversation between myself and TFTC Elite tier members, but we're going to expand that. We'll probably do closed Q&As with people in the industry. I may be doing Macro Mondays. So join us. Go to tftc.io. Subscribe. Find the button in the top right corner of the website. Become a TFTC Elite member. Thank you for joining us. Okay.